Hello traders, Gary Wagner here, approximately 2 o'clock in Honolulu, 8 o'clock in New York. It is Friday. Happy Aloha Friday as we say on the island, 19th day of March 2021, and this is the daily report for gold and silver, our weekend review, and what a couple of weeks we have seen from coming off of a multi-month correction to correctly watching a pivot form and a key reversal in which we got long about $20 from here. Our daily subscribers have seen most of the material I'm presenting today, but in a piecemeal format throughout the week and last week. What I wanted to do was combine everything into a concise description of why we got in, why we place our stops, and our upside targets. I think you'll find it quite revealing. Let's begin the show now. It was an exceptional week for us at the Gold Forecast, specifically our current gold trade that we entered on May 10th. We got in at 1722. Currently, we have gold at 1743.90, up $11.40. We are also long GLD. GLD gained about 0.4% at 163.24. I first want to discuss our gold trade. We're looking at a daily candlestick chart, and really the only thing we're trying to convey in this chart was the main factor that really triggered the buy signal. We looked at the move back from March up till August, and then noticed that when the market corrected, it corrected just at about the 61.8% Fibonacci retracement. I have just put up a box that shows you when we got in, where our initial stops were, and where they are now, because we raised our stops on the 16th of this month. What triggered the buy signal itself? We're looking at this chart with a basic fib retracement. And what is most interesting is after this defined upward move, it corrected to just over 61.8%. But a couple other interesting things occurred, and to really look at that, we'll go ahead and blow this chart up a little bit. And that is after trading just below the 61.8% retracement, in the case of gold, we had a variation off of a candlestick pattern called an engulfing bullish. For it to have been a true or pure engulfing bullish, we would have had to see the market open below the closing price of the prior candle. It would have looked something like this. In silver, we did get a pure engulfing bullish. However, in both cases, you need to get a confirming candle before you actually issue a buy signal. In the case of a bullish reversal pattern, we want to see a following day with a higher low, a higher high, and a higher close. We met all of that criteria, and that's why we entered right here at 1722. And just as in the illustration of suggested stop placements, you would initially begin your first stop below these lows right here. We initially got in at 1722.80 and placed our stop at 1665. So well below the low of the pattern. Then on the 16th of this month, we went ahead and raised our stops. In the case of gold futures, we raised it to 1690, and the rationale behind that was that this was the low here that came in roughly a week ago, and we placed it just below this particular price point. Maintain your current long position. We will look to move our stops up, but most importantly, what I want to talk about is our exit strategy and continue the discussion we began yesterday about 3 alternative Elliott wave models. We are going to present 3 distinct models using different timelines. But first, for those unfamiliar with Elliott Wave, I felt the best way to do that was to show you a short film by Investopedia, the experts on breaking down complex technical studies in a way you can digest.
The Elliott wave theory was developed in the late 1920s by Ralph Nelson Elliott. In his research, Mr. Elliott noticed repetitive patterns in the markets that he attributed to the psychology of the masses. He noted that similar repetitive patterns appeared in all different time frames. Elliott divided these large patterns into smaller patterns he termed waves. The ultimate success of this indicator rests on the trader's ability to divide price action into trends and corrections. Trends show the main direction that prices are headed, while corrections move against the trend. Elliott labeled these impulse and corrective waves. The Elliott wave theory is usually interpreted by a pattern of 5 waves that move in the direction of the main trend, followed by 3 corrective waves. This combination of 8 waves is called a 5-3 move and can be found on any chart regardless of the time frame. Interestingly, each wave in the cycle can be made up of other 5-3 formations of waves using shorter time periods, which can make identifying the current wave a difficult task. The high degree of subjectivity is the main reason why using this theory can be problematic for beginner traders. But by taking the time to figure out the wave count, Mr. Elliott concluded that the movement of the stock market could be accurately predicted.
The fractal nature of Elliott wave means that you will have waves of different degrees, and you accomplish them by using different timelines, meaning a daily chart, a weekly chart, a monthly chart, or intraday chart, and so on. On this first model, we made the assumption that this move in March all the way to the new all-time high at 2,088 was the conclusion of a intermediate fifth wave right here. From there, we enter some sort of an ABC correction. And the first model that I presented assumed that this entire move down was our A. We are now entering our B, and we can forecast our B by using a standard formula that says that the B wave will go anywhere between 50 and 75% of the drawdown that we witnessed on the A wave. And by using that strategy, the following would be our forecast. I've enlarged the chart, but in essence, we are looking at this as our A wave. And now to project our B wave, what we want to do is take a look at what the market could go to if it goes to a 50% retracement of the move down, because that would take us to about 1880. It could go as high as a 75% retracement, and that would take us to 1980. So that is the first model I want to present. Following that, though, we would enter one final C wave. The C wave, this is not drawn to scale, could either take us to a flat, if it did come to this area, be a truncated, but most likely, in most scenarios, the low that you get in the C wave is below the low that was found in the A wave. That is our first model. The next two models that we present are through the use of fractals. If we assume that this was a intermediate count, the next thing we would want to look at is a minor Elliott wave count. The second model we're presenting is a intermediate wave count, which could look something like this. And as you can see, and it is not drawn to scale, but what we are assuming with this is we would take what we had just labeled as a fifth wave and subdivide it once again into a 5 count. 1, 2, 3, 4, 5. And in the same way, what we were calling an A wave would be subdivided into an ABC that would look something like this. So rather than looking at this move down as a single A wave, we would simply say that we got our A, our B, and then our C wave here. And so again, this is a fractal of the larger Elliott wave model that we just presented. The last model will actually move up from primary to a cycle model using a weekly chart. And now this last model is really what I call a major. It is technically labeled as a cycle, and by using the weekly chart, you can see that we are looking at this last move here is a move to a third major wave. And what that means is that we saw this top as a third major wave. We saw this correction as the conclusion of a wave 4, and that, of course, can be subdivided into an A, a B, and a C, which means we're going to have a different method of forecasting where we think the market could end up at. The way that we do that is simply use a Fibonacci extension of 0.618 to represent where the market could conclude at the end of this rally. And by using this technique, we arrive at the following conclusions. We're assuming that this third wave began at approximately 1,264. This, of course, back to 2019. We had a strong multi-year correction that took us to these recent lows. And what we do is we fix our starting point right here. We are using the range created from the low here to the high here. And typically, if you would get a 0.618% retracement, that says that this rally will conclude at a new all-time high at 2183. Realize this is a multi-year projection rather than using a daily chart. But the beauty of creating multiple models is as new data unfolds and price movement goes through time, we have a framework to look at to see if they fit any particular model. This has been Gary Wagner wishing you, as always, good trading. We certainly have some nice trades on this week. Let's hope they pan out with the kinds of numbers that our Elliott wave models are projecting. Have a great weekend.